This is Matthew Cratter from Trader University, and today I want to talk about how the Fed just really spooked the markets. We've been talking about this for a few weeks, about the yield curve inverting and a possible stock market crash coming, and this is looking more and more true. If you were following the stock market yesterday morning, it started off quite strong. We were moving to new highs for this most recent move. All of a sudden, we got a big reversal. And then the market sold off really for the rest of the day. And the main reason for that was one of the Fed governors, Brainard, had these comments about shrinking the Fed balance sheet. And that's what I wanted to talk about today. And if you're new to the markets, you might find this kind of strange reading the tea leaves of the Fed. But it turns out that central banks and their actions, as well as government actions, really are the elephant in the room and the tail that wags the dog of the market. So it's very important to follow this stuff. It seems very occult and very weird and very unnecessary, but the Fed is extremely important. That is, at least until we abolish the Fed and move to a Bitcoin standard. So Brainard's comments, these were prepared comments, I believe, in a video speech, an online speech. She said that the Fed wants to shrink their balance sheet rapidly. She said they're going to continue tightening monetary policy, raising interest rates, and then starting to reduce the balance sheet at a rapid pace as soon as our May meeting. And then this was the key phrase as well, given that the recovery has been considerably stronger and faster than in the previous cycle. And I believe here she's talking about really 2010 to 2017. It was at the end of 2017 that they started shrinking their balance sheet last time. Given then that this recovery has really been V-shaped recovery because it was more of a pandemic thing than a real bear market or financial crisis, I expect, and this is Brainard speaking, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, adding that the cap set to govern the pace of asset roll-off could be significantly larger. And what she's talking about there, back in 2017, they started off by reducing the Fed balance sheet by $6 billion worth of treasuries and $4 billion worth of mortgage-backed securities, and then they increased that to $30 billion and $20 billion per month. So they got up to about $50 billion back when the Fed's balance sheet was much smaller. So these are the comments that are moving the market and continue to force stocks and Bitcoin lower today. We also had some comments from Esther George, talking about how the Fed needs to include the balance sheet in its monetary tightening. As a result of both of these speeches, we saw the probabilities of a 50 basis point hike, in other words, a half a percentage point hike in the Fed funds rate at the next meeting, which is May 4th. It's a 2-day meeting from May 3rd to May 4th. It'll be decided on May 4th. This moved to almost 77% probability that instead of just hiking a quarter of a percentage point, they will hike a half a percentage point. So that is almost baked in unless something really bad happens. Now, the reason people got so upset about Brainard's remarks is she is widely considered what's called a dove. So hawks are people at the Fed who favor higher interest rates and tighter monetary policy, more restrictive monetary policy. And then the doves are people, Kashkari is the prominent dove, saying that there is infinite money available at the Fed, is what he said back in March or April of 2020. Brainard is known widely as a dove, just like Kashkari. In other words, she favors weaker, more accommodative, less restrictive monetary policy. In other words, lower interest rates and a higher Fed balance sheet to manipulate, they call it stimulate, but to manipulate the markets. And so the fact that someone who is as dovish as this, and again, these blue marks here show are on the Hawks scale, so it's basically they're negative hawks. In other words, they're doves. This shows that if Brainard is talking about rapidly drawing down the balance sheet, then this is something that could definitely happen. And these speeches are not just off-the-cuff remarks. What they are, they're test balloons or trial balloons that are put out there to see the market reaction. And this is the bizarre way that modern monetary policy and central banks work. So it's very important, and this is why people watch the Fed tea leaves. If you're finding this video helpful so far, be sure to hit that subscribe and like button. Many of you watch my videos but are not yet subscribers, and I appreciate you subscribing if you're not yet a subscriber. So what's this all about? We've talked about this many times, but for new viewers, the Fed's balance sheet is all of the assets that they are holding. How do they buy these assets, which are mostly US Treasuries and mortgage-backed securities? In other words, government bonds and housing bonds. The way they buy this is they print up fresh new money, and they buy these assets and put them on their balance sheet. And when the Fed is growing its balance sheet, it's very good for asset prices. When the Fed is shrinking its balance sheet, it's very bad for asset prices, especially crypto and the stock market. So the last time the Fed tried to shrink its balance sheet, and this is what Brainard's referring to the last time, and saying that this time they're going to try to shrink it more rapidly. Basically, the balance sheet peaked in 2016, 2017, and then they tried to roll it off just by letting securities mature. In other words, not replacing the bonds that were maturing. And they got their balance sheet down from about 4.5 trillion down to 3.7 trillion by September of 2019. But this had very large effects on the stock market. The stock market had a very good year in 2017, then became very, very volatile and choppy. We had the whole VIX issue in early 2018, I believe it was. And this really spilled into the beginning of 2019 as well. So a Fed rolling off the balance sheet is bad for stocks. When they shrink their balance sheet, it's bad for stocks. And this is why we saw the stock market sell off so rapidly yesterday in response to Brainard's remarks. And the stock market is a forward-looking mechanism. It's always trying to price in things that haven't happened yet. And this sometimes confuses beginners who expect a one-to-one correlation where something happens. For example, a company reports good earnings and immediately goes up. What really happens in reality is it's more complicated than this. The stock usually will start moving up in anticipation of good news being released. And then when the good news is actually released, the stock might not do anything. In this way, what's happening here, and this is how Fed trial balloons work as well, is Brainard comes out with these comments. And even though the Fed has not yet started to shrink their balance sheet, the market starts to price this in, with stocks selling off, as we saw, in imitation of 2018, and things could obviously get a lot worse. We also saw bond yields spiking, especially the 10-year note moving, the yields moving much higher. When the price goes down, the yields go up, and we're hitting new all-time highs, or I should say all-time highs for this interest rate move. Obviously, interest rates were 15 to 20% back in the early 80s, but we're seeing bond yields, U.S. government bond, U.S. Treasury yields spike even more yesterday and then today as well. Now, this is very different. A lot of people are comparing this to the Paul Volcker era of the late 70s and early 80s, when he raised interest rates from fairly low levels all the way up to 15-20%. He caused a recession, but he basically broke the back of inflation. This was a much different era, the Volcker era at the Fed. We can see here, if we look at total public debt as a percentage of GDP, back in the early 80s, it was somewhere around 31%, very low government debt to GDP. In other words, the whole system was much less levered. Now it is much, much higher. We peaked at 135% as opposed to 30%. We've begun to come down with all the inflation, sort of inflating our way out of our debts. But these are still very, very high leverage levels in the economy, and it's basically going to make it impossible to run the Volcker playbook. What we're going to see here is asset prices crash or something else happen, and the Fed is going to have to reverse course, simply because the system cannot stand much higher interest rates. The U.S. government won't be able to pay its debts. In other words, it will have to issue even more bonds to pay off the higher interest payments. Corporations are leveraged. Households are not quite as leveraged as they have been in certain points in American history. But the overall system is highly levered. And it's not just levered using debt. It is piggybacking on the U.S. stock market. So back in the early 80s, very few people were interested in the stock market, especially retail investors. We had the total U.S. stock market capitalization as a percentage of GDP, and we always normalize these things using GDP simply because the economy was much smaller back then. But stock market capitalization, in other words, the value of all the stocks in the U.S., or at least all the major stocks, was somewhere around 40% of GDP. And we can see the huge rise in that percentage over the intervening years. And it looks like this this data actually ends in 2019, but even in 2019 we were at 158%, and I think we're still somewhere around there, around 160%. And so what this means is that the stock market is actually much bigger than the economy as measured by GDP. And so when you get moves in the stock market caused by hawkish Fed policy, it really has an oversized effect, not just on the stock market, but on the economy as a whole. The one thing I don't see anyone talking about when they're discussing Fed monetary policy is the deficit spending that's being monetized by the Fed. All that means is the Fed is printing money, buying US Treasuries, and you basically have the left hand of the US government buying bonds to fund the right hand of the US government. And I understand that the Fed is a private corporation, etc., but it really does function in many ways like a government, like a piece of the U.S. government, and it works very closely with the U.S. Treasury and coordinates with various U.S. government agencies. And the basic problem we have this huge budget deficit, anywhere from $2 to $3 trillion, simply because the U.S. government's only bringing in about $4 trillion in tax revenues. And again, this is from a very strong stock market and a very strong housing market, which is now reversing, and they're spending $6.5 trillion. So they have to make up that difference by borrowing the money. They borrow the money by issuing debt, and then that debt gets monetized, in other words, bought by the Fed using freshly printed US dollars. The debt gets added to their balance sheet grows. And so what this means is if the Fed is shrinking their balance sheet, it means they're no longer buying all these US government bonds. Someone is going to have to buy these US government bonds, but the real problem is we just froze Russia's FX reserves, and we have countries like Saudi Arabia and China and Russia moving off the petrodollar standard. There's a lot less demand for US Treasuries, which used to be the global reserve asset, and is slowly losing that position, which means that we're going to have fewer international and foreign central bank buyers. And now if the Fed is stepping away, this is why the market is selling off bonds and making yields spike. The market's trying to find a point at which interest rates will find a neutral equilibrium without the Fed in the picture. As we said, when stocks and housing go down, tax receipts plummet, then the U.S. government has to issue even more debt and borrow more money. So the real question here, the $21 trillion question is, who is going to buy $2 to $4 trillion of government bonds that fund new government spending? That would be this deficit spending here, in addition to buying all the bonds that need to be issued to pay off the existing maturing bonds. And this is really the ultimate Ponzi scheme, and I think it's rightly called that in many ways, where the government issues new bonds to pay off old bonds. This is how it always works. But the problem is when you have a buyer strike from the buyer of last resort, which is the Fed, things are going to get very, very ugly, and things are beginning to get quite ugly. As we said, historically, the Fed keeps hiking until something breaks. And you can define something breaks. This is sort of a Wall Street euphemism. You can define something breaks as a recession, a nasty recession or economic slowdown, stock market or housing market crash, or you get some break in the financial plumbing, like we got the repo crisis at the end of the last Fed tightening cycle at the end of 2019, which was really a sign that the government was issuing more debt than the market could take down. The banks were full to the gills with US Treasuries, and hedge funds were full to the gills with US Treasuries, and the Fed was shrinking their balance sheet. And so you had yield spiking, and you had the repo crisis in the third and fourth quarter of 2019. And then the Fed had to reverse course. They started printing money again, and then they really started printing money in March of 2020 when the pandemic hit. So once something breaks, as I said, the Fed is going to be forced to cry uncle. In other words, to reverse course and turn the money printers on back at full speed. We don't really know when this is going to happen. We don't know how bad things have to happen before the Fed reverses course. It's obviously complicated by geopolitical considerations. If you have high energy prices, which are caused by the Russia-Ukraine situation, there's no tightening that can really help you with this. This is a geological and geopolitical problem. So the Fed can tighten all it wants. It's not going to pump more oil out of the ground by doing that. So there's some weird things about inflation that the Fed is trying to fight, the energy component of inflation in particular, that it's not really able to fight with monetary policy. You actually have to dig more wells and pump more oil to do that. Now, everyone's looking forward today to the Fed's minute statements. These would be the minutes from the March 15, March 16th meeting, where we get to see what their discussion was. And people will be watching this very closely to see what the discussion was about shrinking the Fed's balance sheet. So we'll get that in the middle of the trading day today. The market's selling off quite sharply in anticipation of this. So we'll see what the members of the Fed, of the FOMC, had to say about shrinking the balance sheet, and see if it lines up with Brainard's comments on the Fed shrinking its balance sheet. In the meantime, Bitcoin selling off. This is a great opportunity. I think I hate to make price predictions, but I do think the stock market sell-off and the Bitcoin sell-off continue, and this is ultimately a good thing for Bitcoin. A lot of people say, how can we have a new money that's subject to the Fed that just sells off whenever the Fed gets hawkish? And the answer to this is the Fed is still in control. We still have the central bankers in control. Bitcoin is this Trojan horse that is slowly disrupting the system. But in the process, and over the last few years, especially since March of 2020, it really has been correlated to risk assets like stocks, even though it is not a risky asset. It has no counterparty risk. It is a true digital bearer asset that cannot be inflated away. You can't print up more Bitcoin, and you can't confiscate it. It doesn't require permissions to use. So it's a very different animal from US Treasuries and from US stocks and other risk assets like US stocks. But it is correlated, for better or worse, at least recently, with stocks. So probably expect lower Bitcoin prices here, as well as lower stock prices. This is ultimately good news for the hodler. If you're a trader and you're going to try to time this, I don't recommend that. So, for example, I haven't sold any of my Bitcoin. Obviously, I'm not trying to time this very precisely, simply because we don't know what's going to happen. The financial plumbing could break in the next couple of days, and the Fed could turn on the money printers instantly, and Bitcoin might move up $20,000 in a matter of minutes. And then if you sold and had to pay taxes because you realized a cap gain on your Bitcoin, or if you sold and you weren't able to get in time, that's the problem. So for long-term holdings, I don't like to trade around these things. We obviously stopped trading momentum stocks at Trader University Premium late last year, as I saw all of this on the horizon. And it turns out that's been a pretty good move to stay away from the high beta, high momentum growth names in this sort of environment. But that will return, and Bitcoin will return. In the meantime, this is going to be a great opportunity. I'm personally hoping for a Bitcoin crash. I would love to see $30,000 Bitcoin, especially in this environment where we know the Fed's going to need to turn the money printers back on. So I think if you view it in this light, in a glass half full light, and if you are a long-term Bitcoin hodler and you're trying to get the lowest cost basis possible, you welcome crashes. If you're just a trader, if you don't really understand Bitcoin and you're in it for the short term, obviously this can be bad news. But for the long-term hodler, lower Bitcoin prices can and will be, I hope, a blessing to all of us. If you found this video helpful, be sure to hit that like and subscribe buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. We'll be looking for the Fed minutes later today, and hopefully talk about them tomorrow if there's anything significant there. Thanks a lot for watching this video, and I'll see you in the next video.